Good Friday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Good. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor. Call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
And let me share my screen. While I'm doing that, quick note, anybody joining us for the first time, Will and I, we do this show in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, you can put that question on the live chat on YouTube. Will's watching it. He'll read it back to me. If you want to come on the show and ask your question live, we do provide a link to Zoom. Click on that link, takes you over to Zoom. Once you're in Zoom, there's a button, raise your hand. Click on that. We'll let you in. You could ask your question live and direct. While we're waiting to give people a chance a couple more people to come in and give you guys a chance to put in your questions. We'll start out with the pre-market report, just to see what's going on in a pre-market hours, see if we could get some insights there, and then we'll go to the questions. Okay, so pre-market report. These are stocks trading in a pre-market hours. I'm going to come down here, and we have three lists. Our most active stocks, our biggest percentage gainers, biggest percentage decliners. I see there are 41 stocks made our percentage gainers list, 21 on our decliners. So from this perspective, so far in the pre-market hours, we're seeing some bullish sentiment. Let's climb up here, look at it from a different perspective. We have this calendar view, and today, September 15th. This is a summary of what's going on in pre-market hours. We have 393 stocks trading higher in the pre-market than the previous day's close, 234 stocks trading lower. If we look at the volume of shares, we got 166 million shares trading on up volume versus 44.4 million shares trading on down volume. And if we convert those shares to dollar value, we have $1.3 billion worth of stock trading up versus $1.2 billion worth of stock trading down. So this also indicates more bullish sentiment in a pre-market than bearish, although this is a little bit of a mixed bag versus dollar value of shares traded up versus down. Let's do one more check, and then we'll go to the questions. So I'm going to scroll down here, and when we took a look at this list of stocks, we see there are small cap stocks in there, ETFs, leverage products, pretty much any security listed on the major U.S. exchange. If it's trading in the pre-market hours and it meets our thresholds, it could make this list. And to narrow down this list to a small group of stocks, you could use the filters above. And you can screen by your watch list if you have one. We're going to use this one, an ETF filter. When you click on it, you get a drop-down menu to select from. The top ETF up here is SPY. That's the S&P 500 ETF. Let's click on that. And when we do that, the list below gets filtered by stocks that are holdings in the SPY ETF. And here we see 2 stocks made our percentage gainers list, 10 are on our decliners list. So from this perspective, looks like a little bit more bearish bias at the open. So far we got a mixed bag, different signals depending on which report you look at. And what do we have? We have the Fed meeting, right? Well, coming up next week. So we got the interest rate meeting coming up. Something to keep an eye out, see what they say. But so far, I think the expectation expectations are they're going to hold this next meeting and probably have to raise one more time in the next meeting, I think in November. So, well, we gave it a couple minutes. I think we could go to the questions now if you haven't.
No questions have really popped in. Some interesting discussion back and forth amongst the community about NVIDIA, how it may be affected. I don't know if it's come up on your radar, but the actual United Auto Workers went on strike today.
Yep.
And I guess a lot of their chips are used in their vehicles. It's going to be interesting what happens. I don't know if that is an immediate effect on NVIDIA, but that was something that was being commented on, which was interesting. I didn't thought about that.
Yeah, I'm not sure about the impact on that. But here's NVIDIA right here. I see it on one of our most active stocks trading in pre-market hours, down 0.4%. So nothing that significant right now.
Not a big move, that's for sure.
No, I think that's still the story is, the AI and the future of AI, right? Eventually this will get resolved, I think, with the auto workers, and I think the market's forward looking like beyond that. But we could see here, small decline so far in the pre-market hours.
Cool.
All right. Let's take a look. If we don't have questions, well, maybe I'll just go default to SPY until we get the question that pops up. Let's go to the. All right, we're on the SPY, and let's take a look at the options chain. We started out looking at analyzing an option from the options chain, and we looked at it from the perspective of using the Black-Scholes model or the option pricing model and calculate this. And yesterday we talked about, I just brought up a September 19th 451 call, clicked on the call price. So I have this buy September 451 call, 98 cents. And if we wanted to see what the price of the option would be if we changed certain assumptions in the option pricing model, we could do it from here. Mainly, we were talking about the implied volatility, right? So if we change the implied volatility assumption, so this is the market implied vol by default populates in there, but what if we wanted to raise it, one click or lower it? We could do it from here, rerun it, and then we could see what the new price would be if those assumptions were correct versus the market price. And that's one way to start analyzing the price of an option, right? So we have the option pricing model with those assumptions, and we can use that option pricing model to try to figure out, well, what do we think the fair price of the option is using our volatility forecasts. So you do need a volatility forecast, assumption in the option pricing model, which is a forward-looking estimate. So that is one way to analyze it, but that's only one angle, right? There's no one right way. There's no one definite way. There are different methods of analyzing options. And let's take a look at this one in IBKR. So this takes historical data and says, well, what is the price of this option, theoretically, if we use, where does it usually trade? Like, what implied volatility do the markets usually assign a similar option? Okay, so this is going back into our database, and finding and finding similar options and calculating a benchmark based on what this option looks like right today. So what do we need? Well, we need the days left to expiration, right? Because that's important. And we need to know how far away the strike is from the stop price. Why do we need that? Because the volatility, we know the implied volatilities are skewed. So if we look at an options chain, right? We're looking at an options chain right now. We see that the implied volatility is different for each option, right? And so you could see it moves around. So we can't apply one volatility assumption for all the options across the board because there's a skew. And the skew is usually based on, how far away the strike is from the spot price. So if the strike is further away to the downside, right, the tail, we usually see the implied volatility moving up. If the strikes are going up, we usually see the implied volatilities coming in. Here, we're not seeing that today for the very high ones, but there is a skew based on how far away the strikes are from the spot price. In addition, we see there's a horizontal skew. So that's a vertical skew. There's a horizontal skew. So the implied volatility itself changes as you go out in time, right? So the term structure looks different. In other words, if we took all these expirations, right, we don't observe the same exact implied volatility. This also, the term structure itself has a skew. So when an option, let's say, starts out 20 days to maturity, when it reaches 10 days to maturity, the implied volatility changes, okay, as it's getting closer to expiration. And because of that, right, we can't use a single benchmark volatility across the board, like the 30-day IV, right? Because the 30-day IV, it looks at a specific synthetic option, which is 30 days to maturity at the money. However, I can't plug that into an option that is 10 days to maturity and it's 5% out of the money, because we're talking about two different types of options now. Okay, so when we try to analyze a particular option on the board, the hard thing is, okay, I need a benchmark Theo for this option, right? That's the option I'm studying. That's the option I'm analyzing. And I need the data that most closely resembles this option. All right. So this is what this is doing over here. It's going back into the database and saying that, and remember, we're not going to get every day an exact option like that. So there is a methodology to interpolate through weighted averages what the implied volatility of that option would be. And it goes back in time and gets us the implied volatility, closing implied volatility of similar options. All right. So that's what this is doing, going back in time and capturing the implied volatility of an option that looks similar. And then based on that, right, we could calculate, well, if we use this implied vol, what would the price of the option be today? If we use this vol, what would the option price be? And so forth. So then, right now we have a distribution of potential prices. We have an average, high, low, and now we could make a much more informed decision, right? Now we could kind of see in front of us how this option is priced relative to how the market usually priced a similar option, right? So here we see that at this time, this option is 98 cents, right? So that's where this option closed at, 98 cents. And in the last 4 years, here's the range. So not counting yesterday, we're looking at all the days before. We see that would be a new low, a closing low. So that's indicating to us, how much that option right now is priced in premium relative to history, right? So you could see how on the low end. Now you can change this data. This is looking at a particular data set. So if you wanted to change the number of years in the data set, we could go back to just 1 year to see how that would look. So you could see the average. We could also take away, so the dynamic IV, it benchmarks it to the 30 IV. Where's the 30 IV level to bring back data where in general where the implied volatility is. But if we took out all the observations, brought them all back, that's how it would look. Okay, so that it's another way of trying to analyze the market from a different angle. Instead of projecting a forward volatility, which you need to do with the Black-Scholes model, we could say, well, let's see where the implied volatility is today relative to its history. All right. And you could form strategies with it, right? So I just put up one type of option. We can add and make it a bull call spread or whatever. Let's come back to this chart. So, and I'm trying to go through questions that I'm recalling from the emails. What if we wanted to just see how this particular option, how did this option perform from day to day? So we're looking at the raw price, right? So this is yesterday. So you see that you're in a yellow, that's the option premium. Oh, I'm sorry, that's the stock price in the yellow. And in the blue, it's the option premium. So from yesterday, you could see where it started out and how the option and stock price correlated with each other. If we wanted to look at the longer history, you could press it, click here. And you could see here that, this option started out September 5th. It was up here, right? The option premium, our snapshot was $2.85. The stock was $449.24. So what happened between then and now? Well, we have the option price in the blue. We have the stock price in the yellow. So we could see that they both declined, right? The stock and the option declined up to September 7th. But what happened after that? Well, the stock started to climb back, right? So look where the stock is, up here. So the stock made it all the way back, but the option is down here. And what does that show us? That's how much the option decayed, right? So you could see that even though we see the stock price and the path it took, went down, came back up, all the way back up here. Let's say it's unchanged, but we could see how much the option itself decayed, because now it went from 285 to, let's say, like 97 cents, something like that, right? So that's kind of one way to, study the dynamics of how the markets work. And we can do that with a call spread. So if we wanted to do that and add, what was the 451 strike I was looking at? What if we did the 50, what if we did this call spread, right? 454 call spread. I'm going to recalculate it. And let's go to the historical charts. This is yesterday. Let's see how a call spread performed. So here, this call spread started out also September 5th, right? Because that's probably when this expiration was listed. So the call spread was $1.22, right? The stock was 449. We could see the stock, what the stock did, and there's the call spread right now at 66 cents. So what happened? Call spread also just decayed because pretty much this is, this call spread was you're buying at the money, selling out of the money, and the stock just remained basically out at the same level. Went down, came back up to the same level. So what if we did a call spread that was in the money? Let's take a look how that looks. Right. So what we did at the time, I think the stock was where 450. What if we, at that time, we sold the 450 and bought the 445. So let's see how that looks. So that looks much better, right? So again, the option, this would have cost us $3.32 at the time, September 5th. The stock was 449.25. So you could see that the stock went down. This call spread kind of remained steady, came in a little bit. So it did come in there from $3.32 to $2.16. And then the stock climbed back up here. And now it's $4.19. So why is that happening? Because we sold that at the money call, which had the highest time premium, right? So when you sell at the money, it has the most time premium. We bought it deep in the money or deeper in the money call. I can't say deep in the money, but an in the money call. So it's an in the money call spread. And what happened was that this spread, a call spread that's in the money, it benefits two ways, right? If the stock went up, obviously, because it's a bull call spread, has a delta, but it also benefits if the stock just sits there and comes back to its original price, because if you're selling that at the money, that's where the biggest time premium is, right? And that's what happened here. So you could see from the start, even though the stock didn't do anything, right? The stock, it moved around, but as far as moved back to its spot. The market didn't, from then to now didn't increase or decrease that much. But what happened to the spread? The spread went from $3.32 to $4.19. So that's a pretty significant return, right? Whatever 25%, that's a pretty significant return for in that time period from September 5th to 14th. So this is one way where you could come in and try to look at, what if I set up different strategies, and given the path of what the stock market did, or that particular stock did, how would this strategy look like, between those periods, right? Between the start and finish. So I can't think of other questions I've been getting through the emails to talk about, Will. So if there are no questions, it's Friday.
Yeah, we can leave. We just had one quick question. You don't have to go into explanation because I'm going to share a video. We answered this question previously, and I just got it from YouTube. It was a new Mark, a newer Chameleon on the chat. He was asking, is it possible to get live-ish market data for any MC charts was his question. And you've gone into this quite a few times, and I grabbed one of the videos I'm sharing and he can watch it. But do you have a quick comment you want to say about our data?
Yes. So the Market Chameleon platform itself, it's designed to be a research platform. Okay, that's what it's designed to do. That is its primary objective, is to be a research platform. It's not an execution platform. It's not a platform where you're using it to execute trades or try to jump on trades. It's really to help answer questions and prepare strategies and look back at data and test your theories, right, to answer questions. So that's what it is designed for and meant for, to work in that fashion. And if we did, so a couple of things here with real-time data as well, that we don't actually control that data. We don't own it. We license it, we purchase it. And there are certain things that we can do with data according to our agreements, with a 15-minute delay data that we can't do with real-time data. And again, things with real-time data, there's a lot of different compliance stuff that you have to deal with that will, I guess, will have to take away some features that you guys already have, right? So because exchanges, they're the ones that own the data, that's their data, and they have like restrictions with downloads and fanning data out and using multiple screens. And so the things that you do with research sometimes, you might not be able to do, with the real-time data that we're displaying here. Okay, so there are other things with real-time data that are issues, that we have popular features that we need to keep, and we wouldn't be able to do that in a real-time fashion. Plus, you're not going to be able to anyway. A lot of these screeners, let's say, when you bring up a covered call screener, you could see that there are lots of analytics in here, right? And it's not just prices, but you got lots of analytics that were crunching numbers going back years to analyze this option, doing back tests. So it's not possible to do that on real-time data, because real-time data itself, there's millions of ticks per second. That's how it comes in. So a data feed, if anybody ever knows it, all the exchanges just push out everything at once as soon as it comes in, and you have to process it. So it's not possible to force a recalculation 1 million times a second. You can't do, there's no system that would be able to do that.
I think that's Mark even realized that, because he said ish. It wasn't like live data. It was data that's closer to live than delayed.
Right.
Because most of the data, when it hits your trading platform, even, is delayed, right?
It's already delayed, because your eye will not see every tick.
Anyway, and
right.
If there was something to act upon, it's already been done inside the process, right? It's
right inside the right. So right. So we do talk to vendors, exchanges, and to look for solutions that maybe we would be able to create on the side that has some real-time data. We're talking to some brokers, because brokers have access to real-time data, because usually, first of all, they have to, right? They need the real-time data to execute trades.
Well, they're supposed to be showing a trade that's available on the platform, right, to trade inside the market.
Well, absolutely. By regulation, they have to have the public feed to execute trades. So there are ways maybe that we could tap into the brokers who have it and can provide like real-time data to their customers, and if we could leverage that. So we do talk to them, and maybe there are ways that we could get some real-time data into an application, but it wouldn't be across the board on the entire platform, right? So I'm just showing you here. There's no way you would be able to recalculate, all this stuff, a million times a second. And anyway, even if you did, you wouldn't be able to see anything, right? You can't see a million different ticks in 1 second. So yeah, when we work with data, there are some limitations.
All right, that was super helpful. We did have a whole video on it at a previous time. I shared that on our YouTube channel. We did have a question from Rob. I know we're now a minute into the open, and maybe we can get it on Monday about triple witching. Maybe you can give your experience and what you think about triple witching, if it has any,
right,
anything really that someone needs to be aware of in the options market on those days. Awesome job, buddy.
All right. Thanks everyone for joining. Stay safe. Have a great weekend, and have a great trading day. Hope to